You thought the Iran war would save your gold. It did not. It exposed how little you actually understood about what you bought. New York, 6:45 a.m. I am on the subway to work. My shoulder is pressed against the train door. I am refreshing commodities on my phone because that is what people do when they are trying to feel in control before the day has even started. Then I see it. Gold is red, in the middle of the Iran war. Not flat, not confused, red. I felt that sharp drop in my stomach because that is the moment the script breaks. The script everybody repeats, the one retail investors whispered to themselves like a prayer whenever the world starts shaking. If things get ugly, gold protects you. That morning, it did not feel like protection. It felt like betrayal. That is exactly why this matters. The real shock in March 2026 was not that missiles were flying over Iran. The real shock was watching millions of people discover that they did not own a safe haven. They owned a story about one.
Everybody is arguing about the wrong fight. One side says war means panic. Panic means safe haven buying, so gold should go up. The other side says oil spikes, inflation spikes, yields rise, the dollar strengthens, so gold should go down. Both sides think they are explaining the move. Neither side is naming what actually changed. Iran war, oil shock, inflation spike, rate cuts dead, dollar up, gold down. That is the chain. Oil is priced in dollars. When oil surges, inflation follows. When inflation follows, the Fed stays tight. When the Fed stays tight, real yields rise. When real yields rise, gold, which pays nothing, becomes the thing you sell. Gold is not being priced first as safety anymore. It is being repriced as collateral damage of energy-driven inflation and real rate fear. Once you see it, March stops looking weird. It starts looking brutally logical. The same missiles that make you want to buy gold can also push oil high enough to make inflation uglier, bond yields hotter, the dollar stronger, and rate cuts less likely. So the exact event that triggers your buy gold reflex can also become the event that makes the market dump it. That is not a contradiction. That is the structure.
Reuters tracked it live. On March 1, spot gold rallied to $5,297 after U.S. and Israeli strikes on Iran widened the conflict. The old script looked alive. Then the oil number hit. Nearly 20% in days. That is not a war premium. That is an inflation signal. And the market treated it exactly that way. 7 straight sessions down. On March 19th, another 4.3%, spot gold at $4,612. By month end, Reuters called it the worst monthly performance since 2008, 13% gone in a war. That is your evidence. Not theory, not backtest fantasy. Gold did not collapse because war stopped mattering. Gold got hit because the war changed which fear mattered first. That is a different universe. Most retail investors are still trading the old one.
7:12. Union Square platform. A man next to me is holding a coffee in one hand and his phone in the other. He glances down, sees red, and his face does that tiny thing people do when they do not want strangers to see panic. Not a big reaction, just the jaw tightening for half a second. Then the train doors close. That is what a broken market myth looks like in public. Small, quiet, humiliating. This is where the safe haven fantasy starts to rot. Most people do not buy gold because they understand real yields, term premium, or inflation pass-through. They buy it because gold feels ancient, solid, moral almost. No counterparty, no CEO, no earnings miss, no app notification telling you the thing that was supposed to calm you down is now down 4% because Brent just ripped and Jerome Powell matters more than the Strait of Hormuz. That is the insult. You thought you bought distance from the system. But in March 2026, gold traded like it was still trapped inside the system's deepest pressure points. Oil, inflation, dollar liquidity, rate expectations. You can call it a hedge. The market called it duration with mythology wrapped around it.
And yes, gold still caught safe haven bids. March 1, March 4, March 10. Every time the headline got worse, it ticked up just enough to keep you loyal. That is not a rebuttal. That is how the trap stays open. The old behavior did not disappear, it just lost first priority. That is what people cannot accept. They want a permanent rule. War equals gold up. Crisis equals gold up. Chaos equals gold up. No. Only if the crisis does not reprice money faster than it reprices fear. In March 2026, the market looked at the Iran war and decided the first-order consequence was not run to gold. It was oil shock. It was inflation risk. It was higher for longer. It was a stronger dollar. It was punishment for non-yielding assets. That sequence is lethal if your entire thesis is emotional. This is where the reframe gets ugly. Person A sees the Iran headlines, opens his brokerage app and doubles down on gold. He thinks it is the fire escape. He's still holding it 3 weeks later, watching it bleed, telling himself the market is irrational. Person B moved into short-duration dollar assets 2 weeks before the worst sessions hit. Not because he predicted the war, because he understood what an energy shock does to rate expectations before the missiles even flew. Same war, same headlines, same nightmarish news cycle. One person bought symbolism, the other person bought the order in which markets rank pain. That is the difference. Not intelligence necessarily, not courage, hierarchy. One person owns the object that feels safe. The other person understands what gets protected first when inflation starts climbing. What gets protected first is usually not your feeling. It is the currency, it is the yield, it is the balance sheet. It is the mechanism that keeps monetary authority believable. That is why this month matters beyond gold. Once an asset loses first response status in a crisis, the crowd still trades it like a reflex for months, sometimes for years. They keep buying the memory. They keep saying gold is gold, as if history is a legal contract. It is not. Markets do not care what an asset used to mean. They care what pressure dominates now. If the dominant pressure is energy-driven inflation, the market will happily force you to watch your safe haven bleed while oil, yields, and the dollar absorb the urgency first. 12:38 p.m., Midtown. I am outside a deli holding a receipt I did not even look at because I am still staring at the chart. Traffic noise, sirens. The weirdest part is not that gold is down. The weirdest part is how fast the mind tries to protect itself. It is temporary. It will catch up. The market is irrational. War always helps gold eventually. Maybe, but that is what people say when they need the narrative to survive longer than the trade. The danger is not that gold can fall in a war. That is just a fact now. The danger is that millions of investors still do not know why it fell, so they will walk into the next shock carrying the same outdated map. They will still think crisis hedge instead of asking the only question that matters. What kind of crisis? A banking panic is not an oil shock. A deflation scare is not a supply shock. If you do not separate those, you are not hedging. You are cosplaying certainty. The market is ruthless with people who confuse historical memory for present structure.
Your model failed. Your lazy, inherited, emotionally satisfying one-line model failed. The market did not betray gold. It betrayed the people who thought one asset gets to keep the same identity in every regime. Think about the man on the subway platform, jaw tight for half a second. He did not just lose money, he lost the version of himself that had it figured out. That is what a broken market myth actually costs. Gold did not fail first, your narrative did. If one oil shock can make the market reprice your protection as collateral damage, were you ever hedging, or were you just buying a story that made you feel like someone who had it figured out? If you still do not know what kind of crisis you are hedging against, you are not done here. One more thing. If you're still holding gold right now, drop a number in the comments. What percentage of your portfolio is sitting in it? I want to see how deep this runs. If you want more videos like this, subscribe.